good afternoon, everyone. For those of you who don't know me, I'm Rick Hanson. I'm a partner in the Banking Finance Unit at Orrick in London. I'm also a member of the practice there. Before we get going, a few thanks to DD Talks for inviting us to join this NPL Days third virtual edition. I understand that it's actually going to be over 1,500 attendees to this event, so potentially a very large and knowledgeable audience tuning in, which is great. Topic today is NPL securitization, and it's my pleasure to moderate. Orrick has handled a large number of NPL securitizations, and Madeleine, I'm sure, will talk more about that. We've got deep involvement on both the buy side and the sell side, as well as with regulators and services and industry groups. And it's clear, certainly to me, that NPL securitization has emerged as a very useful tool and a promising distribution channel alongside more conventional portfolio sales. But enough about that. I mean, we've got a stellar lineup today of NPL professionals. We have representatives on the investor side, from the investment advisory and servicing sector, as well as from the legal and investment banking space. So without further ado, could each panelist please briefly introduce themselves, maybe starting with you, Enrica, in no particular order.
Thank you very much, Rick. I'm working at HSBC. I'm responsible for structured finance in Italy and the ABS origination for the continent.
Thank you, Enrica. Madeleine.
Thank you, Rick. Yeah, my name's Madeleine. I'm a partner based in the Milan of Orrick. I've been with the firm for 11 years and based in Milan for 20, something like that, even though, as you can hear, I advise both on Italian NPL deals and Greek NPL deals, as well as other products, but we're talking about NPLs today.
Thanks, Madeleine. Ilias.
Hello, I'm the founder of the integrated operational platform called Hellenic Investment Recovery Advisors, serving as a full-service advisory, investing, NPL servicing, and the real partner to fund managers in Greece through 3 separate companies. Aegis, it's an advisory due diligence company. EU Praxis is a licensed NPL servicer, and STA is a real collateral management specialist. Thank you.
Thanks, Ilias. Andreas, over to you.
Hello, my name is Andreas Heinzmann. I'm a partner in the Banking and Capital Markets group of the law firm GSK. I'm based in our Luxembourg office, and I'm specializing in securitization.
Thanks, Andreas. And last but not least, Rohan.
Thanks. My name is Rohan Singhal. I'm the principal in the KKR Private Credit team, focused on asset-backed financings and asset acquisitions. I've spent a good deal of time in the NPL space and working at KKR for the past 2 years.
Great. Thank you. So that's the formalities out of the way. I guess we can get started with today's topic. Maybe if I could start with you, Enrica, as you'll have an excellent comparative overview of the European landscape. Most of us will be aware that origination fell off a cliff after the GFC, but 10 years later, largely facilitated by things like the GAC scheme in Italy, the NPL securitization market saw a big revival. But as regulation continues to evolve and banks remain under pressure to reduce their NPLs quickly across the relevant jurisdictions, I was wondering if you could give us an overview of the key markets and the asset types in Greece, Italy, Portugal, and in Spain.
Yeah, sure. I mean, just to give you a general background, it's widely predicted that throughout all the jurisdiction in Europe, there will be quite a big wave of new NPL. And I'm talking about circa 400 billion GBV split amongst the countries. These kind of numbers have been have been supported by the consensus, and they are the result of the predictions for the unemployment rate and the GDP contraction. So by factorizing these two elements without any kind of intervention, that of course will be anyway enacted. We have calculated, as well as the various central banks, like for instance Bank of Italy, this kind of amounts. Now, the new wave will be delayed by the payment holidays that again have been applied in all the jurisdictions. Just to give you an idea, Italy, the SMEs have a moratorium till the 31st of June, mortgages till the 31st of December, Portugal till the 30th of September for the mortgages, Greece the 31st of August for business and self-employed in September. Now, these, of course, payment holidays will delay the wave that will absolutely come. The kind of SMEs that are the NPL that are expected are, again, like in the previous part before the pandemic, equal to circa 40% of the SMEs. Remaining will be unsecured residential. Two countries makes a difference. One is Ireland, with a majority of residential, and another is Spain, again with residential. Otherwise, in the other countries, we'll see the SMEs being the main kind of NPL. Securitization. Securitization will be still used in the countries that we've seen so far. What we can say, looking at the past, is that Italy has done 27 publicly rated securitization, 26 of which have been gaxed. So basically, the senior tranche of the capital structure of the securitization has been guaranteed by the government. Ireland has done 4 securitization rated, backed by residential NPL. And Spain, only 1, and Portugal 2. Greece has done some work, but, and we should see after, has done some work, and we expect also Bank of, we expect in Greece, Alpha Bank, Piraeus Bank, and National Bank of Greece to go out with securitization. Interestingly enough, the 2 jurisdictions that have used and will be using securitization are those where a public guarantee scheme has been implemented. And I refer to GACS for Italy and Hercules in Greece. Another thing that I'd like to mention is that, and it's related to again Greece, is that the Bank of Greece has proposed the establishment of an AMC, so an asset management company, to complement the securitization guarantee. That is very interesting because it replicates what we have seen in the Italian market for the private securitization segment. So the asset management company, which is supposed to buy assets from the various banks, NPL from the various banks, is supposed also in turn to securitize those assets, those NPL, and create a different kind of risk embedded within the capital structure upcoming from the securitization. The intervention of the government in this kind of scheme is basically there to cover the difference that is between the book value of the NPL and the market price. This is not state aid because this guarantee will be paid at arm's length, and the payment is supposed to be via super junior notes or by a fee in cash or in write-off of DTC. So to wrap up the European status of the art, Italy top with securitization activity, and this is not particularly new to us because Italians have always used ABS as a main source of funding, not only in this case for NPL, but also for funding plan of the bank. Then there is Greece that, considering also the magnitude of the country in terms of GDP, in terms of NPL, which is in percentage using a lot, Then we have Ireland with residential, and followed by Portugal and Spain. That, as we have said before, has not really used securitization, but rather sold with straight sale asset, raw asset to the various investors.
Great. Thank you, Enrica, for that insight. It's good news for the securitization markets in those jurisdictions you spoke about once the bank forbearance measures tail off, and it's especially interesting to hear saying about the GAC scheme and the AMCs. But I was wondering if you and Madeleine from Orrick could look into your crystal balls and give us a bit of an idea as to where you think the Italian NPL securitization market's headed in particular.
Enrica, is your crystal ball working? Do you want to take that? Or should I look into mine?
I think it will continue. I mean, it will continue, Madeleine. I don't know whether you agree with me. There is a pause now. We all have seen a pause during the COVID, but it's not only in Italy. This all Europe. Investors have been shy, and maybe Rohan can actually tell us more about this. There has been a bit of being at the window to understand what was going on. That was new to everyone. This pandemic, even the word was new to us. So I think it's gonna be still in place. But I want to draw your attention on one important point. Italian market has been distinguished by others by the existence of two kinds of securitization. One is the GACS securitization, where the senior notes are guaranteed by the Italian government and bought by the originating bank. All the banks, except for the transaction fee that HSBC has managed into the market, all the GACS transactions the senior fees has been bought by the originating bank, while the lower part of the capital structure has been sold to the market, to investors. Okay? There is another segment in Italy that is known less. It is the private securitization, where again HSBC has been extremely active. It resembles the scheme that we have mentioned for Greece. So the bank sold the asset to investors, which are not in this case asset management company, but can have some similarities. And then those investors have actually done securitization to create a different layer of risks. In both cases, in both segments, there hasn't been a real secondary market, not for the GACS nor for the private transaction. We have seen sell down, but it's nothing compared to real secondary market, as we actually need. And I think that Greece will follow. I don't know. I mean, maybe it will follow. Maybe on this, Madeleine can expand more.
Yeah. I think, as we know, Enrica, NPLs have been a feature of Italian finance for such a long time. I mean, the GACS scheme only came in 2016, but of course, we've been securitizing NPLs for a lot longer than that. And because it's been such a big feature, there's been a need for creative solutions in Italy. There's such a huge bulk of huge number of banks all with the same problem. So lots of different solutions have come up. One thing I'm not sure if we'll have time, hopefully we can go into a little bit of detail on, is the idea of a bank creating a servicer platform where they manage the bad loans within the bank, but in a sort of separate entity, which then can be hived down, sold off to an investor along with the notes, the junior piece of a securitization. That's something which we've seen in many different forms. Another thing we've seen is the multi-originator deal, where banks, even from different banking groups, can club together, do a securitization, and then either hang on to the seniors, which they can then use, get a rating on the seniors, use them for funding, or it's more similar to the GACS style. Or get funding in from a senior bank to buy the senior notes, from a third-party investor, and then hang on to the juniors. So, in Greece, a lot less banks, smaller market, but Greece, I think, is benefiting from the creative solutions that have turned up in Italy. And I mean, I thought, Rick, it would be interesting just to go in a bit more detail about the HAPS and the GACS schemes and just have a look at the similarities and the differences if you.
Yeah, absolutely. Yes.
Okay. So actually, Enrica, we should have compared our numbers because on my count, there's at least 30 Italian GACS deals in the market. Maybe you missed those two that Orrick did in December just before the numbers closed. But anyway, I think it's around about 30. I think we're around 80 billion of GBV in aggregate. And this is all since February 2016. So there we go, 5 years. Whereas the Hercules scheme was only introduced in December 2019. Currently, there's only one bank which has got the guarantee, which is Eurobank with the Kyriakopoulos deal. But all of the other three systemic banks, as you mentioned, National Bank of Greece with Pioneer, Piraeus with Phoenix and Vega, and Alpha with Galaxy, they're all pipeline, let's say. They've got the first, the initial application in. In some cases, the deal is closed and they're just waiting for the application to be granted. So all four systemic banks have taken advantage of it. And perhaps Orrick, we act on the Piraeus deals. And we also, as I mentioned, regularly act on the Italian GACS deals. So the common features are, as mentioned, you've got a state guarantee on the senior tranche, at least 2 tranches of notes, but an option also for a mezzanine. The underlying must be non-performing. Possible crystal ball prediction is that possibly in Italy, UTPs may be considered when the law gets renewed in May, but as I say, that's still to be seen. That's just a kind of speculative view there. I mean, I know that there's a lot of discussion about it even 2 years ago when the law was renewed last time, but for now, just non-performing loans. Important features: you have to have a servicer independent from the seller bank, and that's just one of the features to make to create a kind of derecognition is a prerequisite for the both HAPS and GACS, and that's achieved by selling junior and mezz notes to a third-party investor. Rating: the senior notes need to be rated. In Italy, that means two ratings of BBB, whereas in Greece, BB minus from only one agency. As far as I know, just one agency has rated all of the deals, and that's with a private rating. What else? One interesting feature of these laws, which I've never seen before, even though anyone who does securitization could pretty much draw the kind of waterfall that has emerged through market practice through the years. You start with your senior expenses, you get to senior note interest, work all the way down through the subordinated tranches. But both the GACS, Italian GACS law, and the Greek Hercules law actually built into the legislation a fixed order of priority, which I should say in Italy has been taken a bit more, let's say, not quite such a conservative or rigid interpretation, whereas in the Greek deals that we've seen, much more conservative interpretation of the law. Just a bit of a technical example, but in the Greek law talks about kind of paying off the cost of the securitization before you actually create the real waterfall. So I think the conservative interpretation for that is that rather than making a sort of super senior application of the application of the proceeds first of all to those costs, you sort of take them out and pay them before you run the main waterfall. Okay, one of the the hallmarks, let's say, of GACS and HAPS is mandatory deferral of the fees of the servicer if there is an underperformance of the portfolio. And that is tested to the beginning of the deal. As Ilias knows well, a business plan is presented with benchmarks, projected net collections, and if those benchmarks aren't hit, then a percentage of the trigger set out in the law, then a percentage of the servicer fees get deferred either until the performance is restored to 100% or until the senior notes have gone. And the same deferral principle applies to the mezz. Now, the Italian law and the Greek law have slightly different triggers. In Italy, it's 90% whereas in Greece, it's 80%. Similarly, the also linked to servicer performance. Once following calling of the guarantee, the servicer can be terminated once the performance again has hit the trigger. And in Greece, the underperformance or the calling of the guarantee must be linked to the underperformance of the servicer in order for it to be terminated. Okay, so some key differences then. I mentioned the ratings are different. One kind of change the Greeks managed to negotiate in is that you can have fixed rate notes, which I think the main advantage of that is to take away the cost of hedging from the structure. In Italy, you generally see the hedging dealt with as a cap, which is the issuer pays up front. In Italy, whereas in Greece, it's a mixture of English and Greek law, typically an Irish SPV. And another, I have to say, as a lawyer, studying the two laws, the Greek law requires the deal to build in a lot more provisions into the deal documentation. For example, any kind of any fundamental changes to the documentation require the consent of the MEF once the deal is running. If I've got time, can I just say one word on Ryokos, which are very much the thing in Greece. I think all of the deals have a Ryoko right from the start. In Italy, we've tended to build in as kind of half negotiate a framework which you can activate once the deal has started. And again, crystal ball material, I feel as though in Italy there's a possibility that there's going to be just a clarification in the law that Ryokos are possible, because the laws themselves are silent. They're not featured anywhere in the waterfall. It's sort of funded as a kind of reserve. So that's another possibility we could see coming up in the renewal, any amendments done at the times of the renewal. I'll stop there to let someone else have a go. Thank you.
Thanks, Madeleine. That's very interesting, especially the more technical differences between the two schemes. I know that there was some talk last year about where the guarantee fees sat in the waterfall, and that could potentially make deals uneconomic. They were linked to CDS, but all very interesting. So thanks for that. And Andreas, maybe we can turn to you on the topic of structuring and linking the view from a Luxembourg perspective. I know I've personally worked on some Spanish NPL transactions where there was a true sale, and we had a Luxembourg securitization vehicle. But I understand you've also worked on an interesting synthetic deal where there was a Luxembourg law guarantee. So could you just tell us a little bit more about the various structures and what you're seeing from Luxembourg, and in particular why Luxembourg law was chosen for that guarantee?
Sure, I'm happy to do that. We already heard how these securitization transactions are structured, that we have public and also private securitizations. We have securitizations which are mainly governed by the EU securitization regulation, meaning that we have typically the senior and the junior tranche. In Luxembourg, we also see quite often unitranche securitizations, which mean that only the Luxembourg securitization law applies. And indeed, let me view that from, so to say, the issuer's perspective. So typically, either these NPLs are transferred via a true sale documentation to the Luxembourgish SPV, which then will securitize these assets and issue notes to the market. It depends really on the jurisdiction of the originator. You mentioned already Spain. Spain has a very investor-friendly banking monopoly framework, which means that a Luxembourgish unregulated securitization vehicle can become lender of record and lend into Spain, and that's not an issue at all. Obviously, in Spain, there are also certain requirements as regards notarization of the assignment agreements and so on, but that's, I think, fairly standard. assignments typically are also governed by Luxembourg law in order to provide legal certainty to the investors as well. So I think that's fairly standard, the true sale securitizations. What we see now, and it was already mentioned before, with regard to the COVID-19 pandemic, we see clearly an upticking with regard to synthetic securitizations. We have seen that in the past, obviously, because most of the originators of synthetic securitizations are banks or other regulated financial institutions, which typically are not allowed to, let's say, fully transfer the assets out to an SPV, but they need to transfer the risk which pertains to the assets in order to manage their balance sheet. And the Luxembourg securitization law clearly provides for the possibility of a, let's say, synthetic securitization, which is basically the seeking by the originator of credit protection, either via the use of a credit derivative or, let's say, a guarantee. And ultimately, the assets are not transferred via true sale to the SPV, but remain with the bank. But the risk is transferred to the securitization vehicle, and the investors ultimately they bear that risk. As I already mentioned, the risk can be transferred via a credit default swap, for example. That is typically UK or English law governed documentation, or guarantee. I come to that a bit later. Here we have now also in Luxembourg a specific guarantee instrument in place, which is already quite often used in order to structure these transactions. So if we use that guarantee, what is actually happening is that the securitization vehicle will enter into a collateral agreement with the originator, and will then guarantee any failure to pay by the originator in connection with a portfolio of reference obligations. The originator will pay a fee to the securitization vehicle for entering into the collateral agreement and to provide the credit protection. The securitization vehicle will provide the originator with a cash deposit, and the cash deposit is typically funded with the issue proceeds derived from the investment made by the investors. I mean, that's let's say a local law point of view, but I think it's also interesting to hear for the audience. In the past, there were some legal debates also with, so to say, foreign counsel as to whether the provision of a guarantee or also credit default swap could mean that the securitization vehicle actually is carrying out a regulated activity as an insurance company. Obviously, there are arguments to say that's not the case, but it was not free from doubt. And therefore, the let's say the Luxembourgish legal market promoted last year the introduction of a new law on professional payment guarantees. The law was adopted in July 2020 and is already widely used. And in a nutshell, it provides a special regime for personal securities, providing for payment obligation and which are granted in a professional context. Typically, in these arrangements, what we have seen in the past was a so-called first demand guarantee, which in a certain way was very close also to a suretyship. Now with this new law on professional guarantees, we let's say we have legal certainties as to the qualification of such a guarantee. And given that now we have a specific legal framework for that, also the guaranteeing of positions in the context of a synthetic securitization are much clearer now, because this argument as to whether, or the question as to whether such an activity could be considered as an insurance contract basically has been gone. And both for private but also for public securitization transaction, this professional guarantee has been used. And also the European institutions in Luxembourg, in particular the European Investment Fund, they are making good use of that guarantee instrument.
Thanks, Andreas. That's interesting. I wonder whether the Luxembourg guarantee is part of a wider trend, perhaps, of European capital markets, English laws, in the context of Brexit. Who knows? Wait and see on that one. Rohan, if I may, turning to you. Clearly, the pandemic's continued to, it's led to uncertainty, and it's led to investors getting cold feet in certain circumstances of being a bit more cautious. But I'd just be interested from your perspective, how does KKR factor matters such as the decline in the real estate market and the impact on various sectors that COVID has had on your investment decisions, and how's that impacted KKR's ability to participate in them?
Absolutely. So, I mean, obviously, sort of a huge impact to the market as a whole, right, and very important for us too. For the NPLs that we may have acquired in the past across Europe, it'll be a case of applying sort of appropriate sort of asset value discounts where we believe that it'll be harder to sell the assets we own, and indeed, more importantly, I suppose, extension on the timings to exit these assets. The extensions can then be worsened by sort of call it squatter or renter risk, actually, where regulations may be put in place during COVID that make sort of effective possession of these properties harder, and therefore monetization take a lot longer. There are certain regimes, for example, in Spain, where there is a requirement to offer social leases. That's in flux a little bit at the moment, but those sort of risks have made necessary some conservatism on business plans for the assets we own, and obviously then on the assets we might look to acquire. Practically, we haven't seen sort of huge value deterioration from COVID as yet, to be honest. The real estate markets on the resi side in particular has held up reasonably well, but the largest impact we've seen, at least in our portfolios, has been on extensions and timings and being able to sell out the risk in a good fashion. The more difficult, call it operating assets, things like hotels, sort of retail stores, these kind of things have seen a greater value decline, in terms of appetite drying up, and therefore difficult to effectively monetize these kind of assets. Similarly, when looking at investing in these kind of portfolios, we extend deeper sort of asset valuation haircuts than we might have done pre-COVID, even assuming that these assets were probably slightly distressed in the past. We would then also assume sort of more difficulties in sale, finding the right buyer, and therefore extending timing to sale of things. So I suppose that the timing will be the largest focus in the way that we look at these opportunities. It's obviously compounded by the regulation, as I mentioned, on I suppose the real estate side of things, but obviously also then in the courts as well. We've seen in Portugal, for example, various court closures have pushed back the ability to repossess assets effectively. And that has a sort of pretty significant impact in terms of managing the risk and how we might view the acquisitions going forward. It's also placed interesting uncertainty in terms of pricing these transactions. I mean, there's always inherent uncertainty in any NPL transaction, but it's gotten better and better known, let's say, as the market has developed over the past 5-10 years. It feels like that's taken a little bit of a hit in terms of sort of the ability to price that appropriately over the past year or so, as people don't know how long the sort of COVID impact will last. Not just in terms of the pandemic itself, but then the knock-on effects on the legal market and the real estate market, and how long those might tail on for. So that's sort of a harder part to benchmark, and the reason that when we're looking at such investments, to be honest, we're being reasonably conservative and prudent in the way we price it, which has then had the knock-on impact of making it harder for banks to transact, and the reason we've seen a number of processes actually fail over the past sort of 6 months or so. We expect / hope that changes soon, as it feels like we have a better handle on the pandemic now. We've got some visibility on the vaccine rollout, and generally systems are more capable of handling even remote working, for example. So we're seeing we're seeing banks come back to the market, particularly in Iberia, for example, and expect that trend should only improve over the next 3 to 6 months. Lastly, I suppose in terms of the way that we would price such risk, there's a natural risk premium that's attached in a COVID environment, given this uncertainty that investors are demanding, and indeed we're looking for as well. It also dovetails with the increased difficulties around financing such portfolios. Immediately post-COVID, I would say that the financing market sort of retrenched quite considerably. But now we're reaching a point where actually we're seeing similar terms to pre-COVID, which is helping again to close some of that bid-ask gap that we're seeing in terms of investing, both on the straightforward sort of portfolios, as well as starting to take a look again at the securitization market.
Brilliant, thanks, Rohan. That's interesting. It seems right to me that given the expected rises in NPL ratios, there's always going to have to be methods for resolving those, understanding things like foreclosures and servicing in a socially distant environment. Yeah. So I guess securitization is going to be a meaningful part of that going forward. Ilias, turning to you now, you've got a very interesting role as independent monitoring trustee for the HAP scheme in Greece. So could you please share your views, comments, and give us maybe an update on the Greek NPL securitization market with your independent monitoring trustee hat on?
Yes, good evening from my side as well. Greece is the focal point of regulatory attention because of the fact that Greece still has the largest NPL ratio in the EU. And on the background of slower than the initial anticipated NPL reduction target, the Greek authorities additionally introduced in December 2019 the Hellenic asset protection scheme called Hercules, with the scope to further contribute to reducing the overhang of NPLs and the financial stabilities. It's common also, as Madeleine earlier mentioned, that these transactions usually envisage, at least in Greece, the creation of Kyriakopoulos, which could from time to time acquire properties following the enforcement of the secured loans. In this framework, the seller has subscribed a loan facility agreement with the Kyriakopoulos. However, the loans are serviced by the servicer, while the Kyriakopoulos is serviced by a different than the servicer entity. Now, the main task of Aegis, or company who is independent monitoring trustee, is to ensure that the guarantee issuing process is implemented and that obligations of involved stakeholders and the authority included in it are fulfilled. As far as applications, the applications filed for the provision of guarantee shall need to be submitted by April 2021. However, a prolongation of the scheme under the name Hercules II is anticipated, while 3 of the 4 Greek banks might be able to reach single-digit NPL ratios in 2021. As we know, the already approved securitization and the only one application in Hercules are the securitizations related to the Cairo transactions of Eurobank, total value 7.4 billion, with a respective guarantee 2.4 billion. As of today, the applications of Alpha Bank, Piraeus Bank, and National Bank of Greece are still under examination, evaluation, without official approval yet. In the framework of Hercules 1, the 4 systemic banks in total have so far submitted 8 applications, with a total NP securitization of 27 billion euros and senior notes of 10.3 billion euros, while an additional one of 5 billion euros is still expected. Hercules 2 is expected to accept an additional volume of securitization applications in the range of 30 billion. So in total, we speak about 60 billion. It's noted that the banks currently are moving at a very fast pace with the aim of securing the lowest possible commissions as risk premiums based on the lower CDSs falling below 100 basis points actually. It must be noted that most crucial provisions and commitments that are the essential part to the aid-free nature of Hercules transactions are the transfer of the non-performing loans at a price which does not exceed the net book value, the sale of junior and mezzanine notes at a positive price to private investor, not linked in any way to the state or state entities, assignment of an eligible credit rating to senior notes in Greece, as already mentioned, at least BB minus, and the calculation of the Hercules guarantee fee. In addition, most significant KPIs to be monitored are mainly the cumulative and the net cumulative collections. However, and this is very interesting and important fact that legal aspects have to understand, is that if the loss exceeds the profit for the year, the relevant provision of the so-called Hardouvelis law should be activated, which imposes a trade-off of the final and cleared tax receivables through a share capital increase in favor of the Greek state. So to avoid this, the banks are undergoing transformation in which a holding company and a subsidiary bank are being set up. The holding company carries out the securitization by selling to a private investor part of the mezzanine and junior notes, as required by Law 4649, which was voted in 2019 for the Hercules, recording the loss from the difference between net value and actual valuation. In addition, it holds the senior notes and proceeds with equal lending to the 100% subsidiary bank. So in this way, the activation of the so-called Hardouvelis law, as called, he was an ex-minister of finance, is avoided, as the loss is registered by the holding company, while the deferred tax claims are borne by the 100% of the subsidiary bank. I mean, in all cases, however, special care is required, as the law stipulates that the Greek state, legal entities under public law, and entities under the general government, including companies or directly or indirectly controlled by the state, they cannot acquire and are not allowed to acquire mezzanine or junior notes issued in the context of securitization of claims for which an application has been submitted or the guarantee of the Greek state has been granted. And finally, on point on the penalties, again quickly, because Madeleine already mentioned that, after 12 months following the entry into force of Hercules, if on any interest payment date, and that's the interesting part, the cumulative actual collections are at least 20% lower than the expected collections in the initial business plan, then 20% of the Class B due interest is deferred. And also the servicing fees, again, can be, if they're at 8% of the expected net cumulative collections, in respective amount equal of 20% of due servicing fees is also foreseen. So back to you, Richard.
Actually, Ilias, I was gonna say there was a change in the law last year to extend it for 24 months. So no one is looking at servicer performance triggers in Greece for 24 months. And again, linked to COVID, as Rohan was saying, similarly in Italy, they've suspended servicing triggers, again, by kind of ad hoc COVID-related legislation. So it's slightly improved position that rather than the 12 months, which was originally set out in the Hercules law, that's been extended to 24. So it's a way of giving a bit of grace, I suppose, because of the changed COVID environment. Sorry to interrupt you there.
Yeah, this is actually very interesting, because I was actually doing small research, and indeed in Italy has been enacted the law, the rule that Madeleine has actually said right now, but in practice it never happened, not because the performance remained the same, just because there wasn't, it wasn't really applied. Withstanding the performances have somehow delayed in Italy. So it's very interesting that this dichotomy between the rule and what actually happened in the reality.
And also in Italy, it was linked to downgrading of the notes on the GACs. And I don't, as far as None of the GACS notes have been downgraded as a result of kind of changed servicing environment.
No, that's exactly, yes.
We'll see.
We should see. Yeah, what I am actually really observing closely is this UTP, because there is no doubt that the UTP is going to be the bigger market in Italy, and the UTP at the moment present a few difficulties to be securitized. So I don't think, and Madeleine, please correct me if I'm wrong, that it's enough only to do a decree where the GACS is applicable to UTP. You need to change the law for the security.
Quite right. No, absolutely. You'd have to do a series of amendments to Law 130 and the GACS law to permit it.
So interesting. So, Ilias, with your services hat on, I know there's been some proposals, European Commission to, for example, amend the securitization regulations to allow services to be risk retainers in NPL securitizations. I was just wondering if you had a view on that, or how you see the market going forward from the services perspective.
Yes, thank you. Actually, with the current discussion of creating maybe a general framework for securitization to help the recovery from the COVID-19 pandemic, some quick points. I mean, while synthetic securitization and traditional, like the true self-securitization, may not fundamentally differ in terms of the nature of the underlying exposures, risk transing, and capital waterfall structures, I mean, there is a main important difference between the ways of transferring risk from the originator to the investor. So actually, based on the regulatory requirements in the NPL securitizations, originators seek to offload the defaulted assets from their balance sheets, as they requested not to be associated with NPLs. In those cases, the special servicer or the servicer of the assets has much more substantive interest in the workout of the assets and value recovery. So risk retention, NPE securitization, in my understanding, will need to be addressed, I would say, under a special regime when it comes to fulfilling this risk retention requirement in order to be able to better take account of their special characteristics. So potential proposal would be to calculate the risk retention requirement on the basis of discounted value of the exposures transferred to the special purpose entity. And in addition, a servicer in this transaction should be allowed, again, in my opinion, to take on the risk retention slice, given its deal that ensuring the alignment of the interests with those of the investors, given the special position in the NPL securitization transactions, as explained. And finally, it should be ensured, of course, that overall complexity of securitization structures, the associated risks are properly mitigated, and that no regulatory incentive is provided to originator to prefer synthetic over the traditional securitization. So final point, requirements for a simple standardized on-balance sheet securitizations need to be 100% correlated with the criteria for traditional sale securitization. Thank you, Richard.
Thanks a lot. Yeah, I think that's interesting to get that insight, especially as our transactions live or die basically by the quality of the servicing. So having that regulatory impetus to balance the interests of investors and services is key. Rohan, we've spoken a bit about public NPL securitizations, and we've touched on private securitizations as well today, but I just wondered if we could get your views on how KKR approaches the various financing solutions for NPL portfolios. For example, private securitizations as a form of acquisition finance, as opposed to term loan financings and public deals. I guess, from my perspective, that's quite interesting because it raises questions around what type of financing is more cost effective, whether whether term financing is better where you have a less seasoned portfolio, for example, and you have to go through the full rating process to underwrite those cash flows. But interested to know what your thoughts are on that.
I think, so to start off with, in terms of sort of the most efficient options, securitization will still be the most efficient sort of from a financing perspective for a portfolio in theory. Spreads have tightened materially since sort of the COVID wides that we saw, and now is probably an interesting time to be looking at the market. We're seeing it sort of in other asset classes, and same goes for NPLs. One of the difficulties that at least we found in approaching the securitization market is acquiring sufficient portfolio size. So typically the NPL portfolios that have been marketed, call it in Iberia, let's put aside the GACS and HAPS deals, are on the smaller side of things in terms of those sold to investors. And it can take a while to roll up enough assets to then bring to a securitization. The fact or the resulting part of that is these assets have a shorter life than your performing loan portfolios. So therefore, you need to roll up a portfolio faster than you might otherwise have to elsewhere in order to achieve the critical scale needed to have a sort of sufficiently accretive securitization exit. So generally, what we've been seeing or what we've been targeting is sort of moving into these sort of private solutions, usually sort of unrated sort of term loan type facilities, to achieve, call it either a bridge financing solution or at least a solution that allows financing for sufficient term to then look at a refi either again via this private solution or securitization markets if they're conducive or more accretive. So during the depths of COVID, what we found was that sort of banks were still willing to lend. It's not like the market shut down as it did in a couple of other asset classes, but they probably pulled back their advance rates by, call it 10 points plus, and spreads widened out on the cost of financing by even as much as 100 bits or more, which made it very, very difficult to take those kind of financing packages on, particularly a term financing. And it resulted in, again, less accretive prices for the acquisitions of the portfolios. As I mentioned earlier, that has since ratcheted in quite considerably, and actually trading, probably we're seeing terms which are as good or if not better than pre-COVID, where advance rates are again sort of in at those sort of pretty high levels, and not quite at sort of securitization level, but not hugely off either, I would say. And pricing will be the main benefit of securitization, but it's still decently accretive for a purchaser such as ourselves. So, the one important part that we found in securitizations, particularly when looking at sort of rating publicly rated securitizations as well, publicly sold deals, is to make sure that the business plans aren't overbaked. This is an asset class where there is, call it, more investor uncertainty. There is less visibility in terms of how these asset classes are priced and managed in terms of the business plan going forward. And it's important to have call it a true realistic business plan rather than overbaking it, because if investors then find performance deteriorating materially, they're then going to sort of find the next take on of, if you want to be a programmatic issuer, much harder to swallow. So that's an important sort of factor to be bearing in mind when looking at public versus private. You have more flexibility on the private side of things, and easier ways of managing your risk, but probably at less accretive terms.
Thanks, Rohan. So I think we're pretty much at the end of the session now. So I don't know if anybody else wants to raise anything at this point, then please feel free to. I think
I have actually a point I would like to share with Rohan. I want to take advantage of your presence. What do you think about the kind of stop of the market during the pandemic? And I refer to from June to December, where no big transaction really happened. Do you think that was the result of a sort of uncertainty, or it was because there wasn't a match between pricing offered and price that the originating bank were able to accept?
To be honest, I think that is the large part of it, right? I mean, in all.
So what do you think it has been the real underlying reason?
Yeah, so I think that's exactly part of it, right? I think the pricing expectations between the banks and the investors was pretty markedly wide in the depths of COVID from May through till even I'd call it sort of October, November of last year. We saw a number of transactions fail in that period that we participated in, just on the basis of even at the NBO stage, banks just weren't getting the right pricing levels that they needed to meet their level of provisioning. And they hadn't got the level of provisioning that we believed would be necessary against these books. So it was just a distinct mismatch there. That seems to be sort of tapering away now, driven sort of by both sides, I would say. One by, call it increased provisioning and maybe more realism on the bank side as to what sort of haircuts they'll need to be taking on pricing in this sort of post-COVID world, the additional premiums that investors will be seeking. But then conversely as well from the investor side of things, as there's more certainty in COVID, as there's more certainty in terms of regulation, as we work through some of these moratoria, there's a more ability for the investors to take some forward steps as well. And particularly in a market where, as you're saying, so little has traded over the past sort of call it half a year or so, there's a lot of capital that's sort of waiting to be deployed and needs to be deployed. So it can be a little bit of a first mover question as well. Who's willing to start going down that risk spectrum a little bit and hoping, I suppose, hoping that the servicer can work out the assets in a satisfactory manner.
Great, thank you very much. I'd like to just say thanks to all the panelists for their contributions. I guess for the audience, they should feel free to follow up with any of the panelists or myself with any questions or with DD Talks. So I think that's it for now. So thank you very much and bye.